My dear students, welcome back to our channel. In this video, I will be explaining the BBA second semester subject Financial Accounting as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 4, the important short question is: what do you mean by financial statement analysis? Financial statement analysis means checking and studying a company's financial statements like balance sheet, profit and loss account, etc., to understand how the company is performing financially. It helps us know: is the company earning profit or loss? Is it strong enough to pay its debts? Is it growing or not? We mainly use tools like ratio analysis, example, current ratio, profit ratio; comparative statements; common size statements; trend analysis. Example: let's say you want to invest in a company. By analyzing its financial statements, you find that its sales are growing every year and it's making more profit. So, you may feel confident to invest. In simple words, financial statement analysis is like a report card check. It tells us if the business is doing well or needs improvement. It's very useful for investors, bankers, and company owners. Easy to remember, analysis is equal to understand the health of a business. Next important short question is: 2. What do you mean by vertical analysis? Vertical analysis is a method of financial analysis where we show each item in a financial statement as a percentage of a base amount. In the profit and loss account, the base is sales, 100%. In the balance sheet, the base is total assets or total liabilities, 100%. This helps us compare each item with the total and understand how much each item contributes. Example: if sales is equal to 1 lakh rupees and salary expense is equal to 20,000 rupees, then salary is 20,000/1 lakh times 100 is equal to 20% of sales. This tells us that 20% of the sales income is spent on salaries. Easy to remember. Vertical is equal to top to bottom percentage of total. So, vertical analysis helps us compare items easily, even if the business size changes. It's useful for studying company structure and cost control. Next important short question is: 3. What do you mean by horizontal analysis? Horizontal analysis means comparing financial data of a company over 2 or more years to see the changes or trends. It helps us understand: is the company growing or shrinking? Are profits increasing or decreasing? How expenses are changing year by year? We calculate the difference and percentage change between years. Example: let's say a company's sales were 5 lakhs rupees in 2022, 6 lakhs rupees in 2023. So, the increase is equal to 1 lakh rupees. Percentage increase is equal to 1 lakh/5 lakhs times 100 is equal to 20% increase. Easy to remember. Horizontal is equal to side-by-side year-to-year comparison. It is just like comparing report cards of a student for 2 years to see whether marks improved. In business, this shows growth or decline over time, which is very useful for investors, management, and banks. Next important short question is: 4. Ratio analysis. Ratio analysis means using simple mathematical formulas, ratios, to understand a company's financial performance. These ratios help us know how well a business is doing in areas like profit, liquidity, efficiency, and solvency. It is like checking the health report of a company using numbers. Example. If a company has current assets is equal to 1 lakh rupees, current liabilities is equal to 50,000 rupees, then current ratio is equal to 1 lakh / 50,000 is equal to 1. This means the company has 2 rupee to pay every 1 rupee of short-term debt. That's a good sign. Main types of ratios. Liquidity ratios, to check short-term strength, example, current ratio. Profitability ratios, to check profits, example, net profit ratio. Solvency ratios, for long-term debts, example, debt-equity ratio. Easy to remember. Ratios is equal to financial shortcuts to judge business health. Useful for investors, students, and company owners. Next important short question is 5 financial ratios. Financial ratios are simple mathematical formulas used to check the financial strength and performance of a business. These ratios help compare different parts of the business like profit, sales, assets, and debts. They make it easy to understand. Is the company earning profit? Can it pay its bills? Is it using money wisely? Example. Let's say a company has net profit is equal to 50,000 rupees. Sales is equal to 2 lakhs rupees. Then net profit ratio is equal to 50,000 / 2 lakhs times 100 is equal to 25%. This means the company earns 25 rupee profit for every 100 rupees of sales. Types of financial ratios. 1. Profitability ratios, show profit, example, net profit ratio. 2. Liquidity ratios, show short-term strength, example, current ratio. 3. Solvency ratios, show long-term financial health, example, debt-equity ratio. 4. Efficiency ratios, show how well resources are used, example, stock turnover ratio. Easy tip. Financial ratios is equal to fast way to understand a business in numbers. Next important short question is 6. Liquidity ratios. Liquidity ratios show whether a business can pay its short-term debts, like bills, salaries, rent, on time using its current assets, like cash, bank, stock, debtors. It tells us how quickly a company can convert its assets into cash to meet daily needs. These ratios are very important for banks, investors, and business owners. Example. Let's say a company has current assets is equal to 1,20,000 rupees. Current liabilities is equal to 60,000 rupees. Then, current ratio is equal to 1,20,000 / 60,000 is equal to 1. This means the company has 2 rupee to pay every 1 rupee of short-term debt. That's safe. Main liquidity ratios. 1. Current ratio is equal to current assets current liabilities. 2. Quick ratio is equal to current assets, stock, current liabilities. Easy to remember. Liquidity is equal to ability to pay now. Liquidity ratios check if a company has enough cash or near cash items to survive today. Next important short question is 7. What is solvency ratio? Solvency ratio shows whether a company can pay its long-term debts in the future. It checks the financial strength of a business in the long run. If a company has high solvency, it means it is safe and stable. If solvency is low, it may struggle to pay big loans or liabilities. Example. Let's say a company has total debts is equal to 5 lakhs rupees. Shareholders' funds is equal to 10 lakhs rupees. Then debt-equity ratio is equal to 5 lakhs 10 lakhs is equal to 0.51. This means the company has 50 paise debt for every 1 rupee of owner's money, a good sign. Common solvency ratios. 1. Debt-equity ratio is equal to total debt shareholders' equity. 2. Interest coverage ratio is equal to profit before interest and tax interest. Easy tip to remember. Solvency is equal to strength to survive in the long run. Solvency ratios are helpful for banks and investors before giving big loans. Next important short question is 8. Turnover ratios. Turnover ratios, also called activity ratios, show how well a business is using its assets to earn money. These ratios help us understand how quickly the company is selling goods or collecting money. Higher turnover means better efficiency and faster business movement. Lower turnover may mean slow sales or poor management. Example. Let's say, cost of goods sold is equal to 6 lakhs rupees. Average stock is equal to 1,20,000 rupees. Then, stock turnover ratio is equal to 6 lakhs divided by 1,20,000 equals 5 times. This means the company sold and replaced its stock 5 times in a year. Common turnover ratios. 1. Stock turnover ratio is equal to cost of goods sold average stock. 2. Debtors turnover ratio is equal to credit sales average debtors. 3. Creditors turnover ratio is equal to credit purchases average creditors. Easy tip to remember. Turnover is equal to how fast things move in business. Turnover ratios help in checking speed and efficiency of operations. Next important short question is 9. Limitations of ratio analysis. Ratio analysis is useful, but it also has some limitations. It gives only a part of the picture and cannot explain everything about a business. Main limitations. 1. Depends on past data. Ratios use old financial data, which may not show the current situation. 2. No standard rules. Different companies may use different methods, so comparison is difficult. 3. Ignores non-financial factors. Ratios don't show employee quality, customer satisfaction, or market conditions. 4. Window dressing. Companies may hide true facts in accounts to make ratios look good. 5. Only numbers, no reasons. Ratios show what is happening, not why it is happening. Example. Two companies may have the same profit ratio, but one may be losing customers, the ratio won't show that. Easy to remember tip. Ratios are helpful but not perfect. Always use ratios plus other analysis for the best understanding. Next unit 4. Long questions. First important long question is: what is a financial statement? Write its various sources. What are financial statements? Financial statements are official records that show the financial performance and position of a business. They help us know if the business is profitable, how much money it owns or owes, and whether it is financially healthy. Main financial statements. 1. Trading account shows profit from buying and selling goods. 2. Profit and loss account shows total profit or loss after all expenses. 3. Balance sheet shows assets, liabilities, and capital. 4. Cash flow statement shows movement of cash in and out of the business. 5. Statement of changes in equity shows changes in owner's capital. Sources of financial statement information. 1. Journal and ledger books. Every transaction is first recorded in the journal and then posted to the ledger. These records are used to prepare final accounts. 2. Trial balance. A summary of all ledger balances. It is the base for preparing trading, P&L, and balance sheet. 3. Invoices and bills. Sales and purchase invoices give accurate data for sales, purchases, and expenses. 4. Bank statements. Used to check cash and bank balances and reconcile them. 5. Payroll records. These show salaries and wages paid, which go into the P&L account. 6. Inventory records. Help in calculating closing stock value, important for the trading account and balance sheet. 7. Loan and asset documents. These give information on long-term liabilities and fixed assets. Easy example. Suppose a shopkeeper keeps a record of all goods bought and sold, salary paid to staff, cash in hand, and items in the shop. At the end of the year, he uses all this information to prepare his trading AC, profit and loss AC, and balance sheet. Quick tip to remember. Financial statements are built from records, journal, ledger, trial balance, final accounts. They help business owners, banks, and investors to understand the business clearly and make smart decisions. Next important long question is to explain the different techniques of financial statement analysis. Financial statement analysis means checking the company's financial statements to understand its profitability, liquidity, and overall health. There are different techniques used to analyze these statements. Main techniques of financial statement analysis. 1. Comparative statement analysis. It compares financial data of 2 or more years. Helps to see the increase or decrease in income, expenses, assets, etc. Example. If sales in 2022 were 5 lakhs rupees and in 2023 were 6 lakhs rupees, we see a 1 lakh rupee increase. This shows growth. 2. Common size statement analysis. Every item is shown as a percentage of a base item, like total sales or total assets. Helps compare with other companies or industries. Example. If net profit is 1 lakh rupees and sales are 5 lakhs rupees, then net profit is equal to 20% of sales. Easy to compare with others. 3. Trend analysis. Shows movement over many years, usually 3+ years. Helps understand if the business is improving or declining. Example. If profit increases from 1 lakh rupees, 1,50,000 rupees to lakhs rupees in 3 years, trend shows steady growth. 4. Ratio analysis. Uses formulas to measure different financial strengths like liquidity, profitability, solvency, etc. Examples of ratios. Current ratio is equal to current assets, current liabilities. Debt equity ratio is equal to total debt, shareholders' equity. 5. Cash flow analysis. Focuses on cash inflow and outflow. Useful to know cash availability for day-to-day operations. Example. A business may show profit, but if there's no cash, it can't pay bills. Cash flow statement helps detect this. Quick tip to remember. C. Comparative. C. Common size. T. Trend. R. Ratio. C. Cash flow. CCTRC is the shortcut to remember all techniques. These techniques help owners, banks, and investors make better decisions about the company. Next important long question is 3. Explain the uses of ratio analysis. What is ratio analysis? Ratio analysis means using simple mathematical formulas, ratios, to check the financial health of a business. It compares to related numbers from financial statements to understand profitability, liquidity, efficiency, etc. Main uses of ratio analysis. 1. Measuring profitability. It shows whether the business is earning enough profit. Example. Net profit ratio is equal to net profit sales times 100. If net profit is equal to 1 lakh rupees and sales is equal to 5 lakhs rupees, ratio is equal to 20%. This means the business is earning 20 rupee profit on every 100 rupees of sales. To checking liquidity. It tells if the business has enough cash or assets to pay short-term bills. Example. Current ratio is equal to current assets current liabilities. If ratio is to 1, it means the business has 2 rupee to pay every 1 rupee of liability. That's good. 3. Testing solvency. It shows if the company can pay long-term loans. Example. Debt equity ratio is equal to debt equity. Lower the ratio, safer the company. 4. Operational efficiency. It helps measure how efficiently a business uses its resources. Example. Stock turnover ratio is equal to cost of goods sold average stock. Higher ratio means fast sales and less money stuck in stock. 5. Comparing with others. Ratios help compare your business performance with other companies or industry standards. Example. If your profit ratio is 25%, but the industry average is 30%, you know you need to improve. 6. Useful for decision making. Owners, investors, and banks use ratio analysis before making important decisions. Owner, is my business improving? Investor, should I invest in this company? Bank, can I give this company a loan? Easy tip to remember uses block T. P. Profitability. L. Liquidity. O. Operational efficiency. C. Comparison. D. Decision making. I. Investor use. Conclusion. Ratio analysis is a powerful tool to understand business performance in a simple and smart way. Next important long question is 4. Write in brief about the various profitability ratios. What are profitability ratios? Profitability ratios help us understand how much profit a business is earning from its sales, assets, or capital. These ratios show if the business is doing well or not. Let's learn the main profitability ratios one by one. 1. Gross profit ratio. Formula. Gross profit divided by net sales times 100. This shows how much profit is made before deducting other expenses. Example. Sales is equal to 5 lakhs rupees. Gross profit is equal to 1,50,000 rupees. Gross profit ratio is equal to 1,50,000 divided by 5 lakhs times 100 is equal to 30%. Means business is earning 30% gross profit. To net profit ratio. Formula. Net profit divided by net sales times 100. This shows the final profit percentage after all expenses. Example. Sales is equal to 5 lakhs rupees. Net profit is equal to 50,000 rupees. Net profit ratio is equal to 50,000 divided by 5 lakhs times 100 is equal to 10%. 3. Operating profit ratio. Formula. Operating profit divided by net sales times 100. This shows how much the business earns from its main activities, not from other incomes. Example. If operating profit is equal to 70,000 rupees and sales is equal to 5 lakhs rupees, operating profit ratio is equal to 14%. 4. Return on capital employed, ROCE. Formula. Net profit before interest and tax divided by capital employed times 100. It shows how well the business is using its capital to earn profit. Example. Profit is equal to 1 lakh rupees, capital is equal to 5 lakhs rupees. ROCE is equal to 1 lakh divided by 5 lakhs times 100 is equal to 20%. 5 earnings per share, EPS. Formula: net profit after tax divided by number of shares. Shows how much profit is earned per share. Example: profit is equal to 1 lakh rupees, shares is equal to 10,000. EPS is equal to 10 rupees. Easy trick to remember, gone are. G. Gross profit ratio. O. Operating profit ratio. N. Net profit ratio. E. Earnings per share. R. Rows. Conclusion: profitability ratios help students, business owners, and investors know how profitable a business is. They are easy and very useful for analysis. Next important long question is: 5 balance sheet of Mr. Suraj Steels for the year 2018 is presented below. Liabilities 2018, assets 2018. Equity share capital 1 lakh, land 1,90,000. 10% preference capital to lakhs 50,000, plant and machinery to lakhs 50,000. 11% debentures 1,50,000, investments 1,15,000. P&L account 1,50,000, debtors 1 lakh. Creditors 1,10,000, bills receivables 40,000. Profit and loss account 35,000, debtors 1,40,000. Creditors 1,10,000, bills receivable 40,000. Bills payable 70,000, stock 1 lakh. Outstanding salaries 25,000, cash 40,000. Marketable securities 20,000. 8 lakhs 40,000, 8 lakhs 40,000. Additional information: sales 18 lakhs rupees. Calculate: A. Quick ratio. B. Cash ratio. C. Debt equity ratio. D. Return on investment. E. Inventory turnover ratio. F. Assets turnover ratio. Each ratio is explained step by step with formulas and values. Given: sales is equal to 18 lakhs rupees. From balance sheet, values needed. Current assets is equal to debtors 1,40,000 rupees plus bills receivable 40,000 rupees plus stock 1 lakh rupees plus cash 40,000 rupees plus marketable securities 20,000 rupees is equal to 3,40,000 rupees. Current liabilities is equal to creditors 1,10,000 rupees plus bills payable 70,000 rupees plus outstanding salaries 25,000 rupees is equal to 2,05,000 rupees. Inventory, stock, is equal to 1 lakh rupees. Cash and marketable securities is equal to 40,000 rupees plus 20,000 rupees is equal to 60,000 rupees. Debtors plus bills receivable is equal to 1,40,000 rupees plus 40,000 rupees is equal to 1,80,000 rupees. Total debts is equal to 11% debentures 1,50,000 rupees. Equity is equal to equity capital plus P&L account is equal to 1 lakh rupees plus 1,50,000 rupees is equal to 2,50,000 rupees. Total capital employed is equal to total assets is equal to 8,40,000 rupees. Net profit is equal to P&L account, profit, is equal to 1,50,000 rupees. A. Quick ratio. Formula: quick assets divided by current liabilities. Quick assets is equal to current assets. Stock is equal to 3,40,000 rupees to 1 lakh rupees is equal to 2,40,000 rupees. Quick ratio is equal to 2,40,000 rupees divided by 2,05,000 rupees is equal to 1.17, 1, good ratio. B. Cash ratio. Formula: cash plus marketable securities divided by current liabilities. Cash ratio is equal to 60,000 rupees divided by 2 lakhs 5,000 rupees 0.291. C. Debt equity ratio. Formula. Total debt divided by equity is equal to 1,50,000 rupees divided by 2,50,000 rupees is equal to 0.61. D. Return on investment ROI. Formula. Net profit divided by capital employed times 100. ROI is equal to 1,50,000 rupees divided by 8,40,000 rupees times 100 is equal to 17.86%. E. Inventory turnover ratio. Formula. Cost of goods sold divided by average inventory. Assume COGS 75% of sales is equal to 13,50,000 rupees. Inventory turnover is equal to 13,50,000 rupees divided by 1 lakh rupees is equal to 13.5 times. F. Assets turnover ratio. Formula. Sales divided by total assets is equal to 18 lakhs rupees divided by 8 lakhs 40,000 rupees is equal to 2.14 times. Summary table. Ratio name answer. Quick ratio 1.17:1. Cash ratio 0.29:1. Debt equity ratio 0.61. Return on investment 17.86%. Inventory turnover ratio 13.5 times. Assets turnover ratio 2.14 times. Next important long question is 6. Given that current ratio is 1.75, liquid ratio is 1.25, net working capital is 1,50,000 rupees. You are required to calculate A. Current assets. B. Current liabilities. C. Quick assets. D. Stock. Given. Current ratio is equal to 1.75. Liquid ratio is equal to 1.25. Net working capital is equal to 1,50,000 rupees. We need to find A. Current assets. B. Current liabilities. C. Quick assets. D. Stock. Step 1. Use the formula for current ratio. Current ratio is equal to current assets current liabilities. Given 1.75 is equal to current assets current liabilities, equation 1. Also, net working capital is equal to current assets current liabilities. Given 1,50,000 rupees is equal to current assets current liabilities, equation 2. Step 2. Solve the equations. Let current liabilities is equal to X. Then from equation 1, current assets is equal to 1.75 times X. Now plug into equation 2. 1.75x, X is equal to 1,50,000 rupees. 0.75x is equal to 1,50,000 rupees. X is equal to 1,50,000 rupees divided by 0.75 is equal to 2 lakhs rupees. So, current liabilities is equal to 2 lakhs rupees. Now from equation 1, current assets is equal to 1.75 times 2 lakhs is equal to 3,50,000 rupees. Step 3. Use the liquid ratio formula. Liquid ratio is equal to quick assets current liabilities. 1.25 is equal to quick assets 2 lakhs. Quick assets is equal to 1.25 times 2 lakhs rupees is equal to 2,50,000 rupees. Step 4. Find stock. Stock is equal to current assets, quick assets, is equal to 3,50,000 rupees to 2,50,000 rupees is equal to 1 lakh rupees. Final answers. Requirement value. A. Current assets 3,50,000 rupees. B. Current liabilities 2 lakhs rupees. C. Quick assets to lakhs 50,000 rupees. D. Stock 1 lakh rupees.